you could get either one of these. The idea of a 30% per year should trigger you to think about, man, under what conditions does that not get me my financial objectives? So we could do the math to figure out which one operationally is a better way to achieve performance. But I want to really start you by focusing on the fact that a 30% per year, even if it's just one opportunity a year, if the operational important point is a 30% rate of return, regardless of how I get it, does that allow me to get my financial objectives? And if I can do that with just one opportunity a year, I've just created a bunch of time that's now available. I don't have to get into all the effort that it takes for B, which would clearly take some work. Now we could get into the bonus question about A, when is A equal to B? And as you guys point out, if you use 0.25% of portfolio and multiply it by the expectancy of B, if you're using 0.25% of the initial portfolio, then you get to the return for A a lot faster. If you compound that, it's even less than that. But the point is that a lot of times we get into the technical, tactical pieces of comparing systems without looking at the purpose of the investing and trading, and that is to meet my financial objectives. And to recap my earlier discussion about objectives, there's kind of two ways to, at least, that you can go about doing that. One of them is to say, let me start with a clean sheet of paper and just imagine an unconstrained future world that describes what I want, and then I'll figure out how to get there. And then you spend your time to figure out ways to get to that initial vision of the future. The second way would be to say, let me start with what I think are a reasonable set of performance measures that are achievable in the world, and from that, construct a set of performances with acceptable levels of risk that seem to be sustainable and achievable, and then use that to project forward on what I could get under those conditions. The advantage of that is that you've already identified the means by which you can achieve your ends. The downside of that is that it kind of locks you into your initial expectations of performances. And so you don't get the possibility of transformational experiences. I think Dr. Tharp's teachings show that when you suspend disbelief and start fresh and create the goals you really want, that the creative and critical thinking skills that we have, the ability to reframe, can often transform the way you do business in order to achieve goals that would have not been possible from your earlier constrained point of view. So I can see that from both angles. And I try to do both of those things, to suspend disbelief and say, well, let me just start with the end and work backwards and try to find ways to get there. At the same time, carry forward what I know to be true about the world, using the benefit of experience and exposure to other ideas, and say these things are actually possible. So one of the ways you can get the hybrid approach is to look for performances, reverse engineer them to see how it is those things are achieved and if it's still replicable. And then that may actually show you ways that you didn't know to get to the goals that you want. So a means-driven versus an ends-driven approach. And that ought to get you into your own psychological space to map your own process. How exactly do you come up with your financial objectives and goals, and how do you validate opportunities? So on the surface, this A versus B is really the difference between core trading and swing trading as a philosophical approach, as a practical approach, that core trading, we're trying to minimize the activity and let the larger natural forces move us into stronger positions that outperform the market averages. That's system A. System B would be the case where we're trying to take advantage of inventory management and process control and reliably manufacture smaller pieces of R more frequently. And one of the advantages of doing B is that you get so many more opportunities. You can still determine if the aggregate system, the meta system, is still performing to the original specifications. Like, we're 2 months into it, are we still getting 60% winners and 40% losers and averaging 2 to 1 on the payoff? Well, system A only gives you one opportunity a year to find out if that thing is still following through, and it's either kind of like a yes or no, and then it's too late to do anything about it. So one of the reasons to favor B is if you have a belief that it's important or useful or reasonable to do continuous process improvement. It may be that through studying those systems, I can actually improve the win rate or the payoff rate too, or increase the number of trading opportunities. So there's a reason to be interested in B, because if you actually had those numbers with a very small percentage of risk of the portfolio per trade, your portfolio heat would be small. Your ability to make adaptive decisions to a marketplace that's dynamic is better. I mean, what if the world changes? What if there were a coronavirus? Yeah, my sound is working over here. It may be on your end. The recording will have it squared away though. So another way to drill into this. Let me just finish up saying. So this really goes a lot deeper than a simple choice between A and B. This is really the start point for looking into your own psychology and your own operational process for achieving your goals and objectives. And that's probably its own important lesson. Another way to look at this, and this gets to Ashok's question of we're going to see here in a minute. He asked me to talk about core. So another way to look at this was, imagine if we expanded system B and it looked like very specific systems. So what I teach in the swing course, now there's a mechanical swing course that's available at the Tharp Institute. There is a legacy swing trading course available for our subscribers on, for silver and gold and platinum subscribers on Basecamp, which has two components. One is a set of mechanical systems, and you see those there, the overreaction, channeling, triple screen, washout, 5DD, and the max pain systems. Each one of those is a mechanical system that can be traded robotically. In fact, the TradeStation bundle actually automates all of that stuff, even to the point where you could automate the entries and trade management if you want, or you just use it as a setup. But a mechanical system means that we're eliminating the redundancy or the discretion of the human trader. We're just following the rules. That's a systematic system. Excuse me. The hybrid and advanced swing trading course relaxes a lot of those criteria and says we actually have patterns and strategies that offer the trader some discretion. And so you can modify the rules and adapt them to that particular trade frame. When we do trade framing, what we're doing is taking a strategy approach in which we take these kinds of patterns and systems as guidance, but then put a trade frame on them to construct a particular case study or hypothesis each trading moment. It follows the principles of these systems, but it allows for discretionary frames and maybe some discretionary management. In fact, most of the discretion in hybrid trading has to do with managing the trade and exiting the trade according to market and sector conditions. Whereas the systematic approach that's in these documented systems really just takes the form of follow with a trailing stop of some size and just take the exit. So that's kind of the choice you got to make as a swing trader. How much discretion do I want to put in there? That's what that whole swing trading course is about. Well, when I'm comparing System A and System B then really was taking all the signals from all of those systems and just following the rules for each independent system, aggregating them into a meta system for System B. And those typically last 2 to 10 days in swing trading. System A then looks more like the monthly rebalancing system. And so now there's a relationship for hybrid trading between these two, that System B swing trades, 9 times out of 10 are responding to a tactical opportunity in which there's a temporary imbalance between price and fair value because something changed in the world, new earnings or new opportunities or better efficiency, a change of leadership, new legislation, whatever it may be, new technology, new products. That there's some momentary imbalance between where the price is and what the consensus fair value is. And so that imbalance triggers some exceptional buying and selling, which moves the price sharply in either direction in a short period of time so that the new balance can be found, the new fair value. Price discovery is the term for that. And in swing trading, those anomalies seem to last from 2 to 10 days. So most of the time, when that swing trade is over, then it's over. The thing that caused the imbalance has been satisfied or solved, and now there's no more follow-through momentum, and then people, cash their excess positions, and the thing settles into its normal sideways choppy movements until the next time that there's an anomaly. Well, each one of those systems is looking for a reliable imbalance that in the past has triggered some focused buying or selling pressure. Like the overreaction system suggests that when a stock or an ETF or the market has been moving up in a strong bull, but then there's some adverse piece of noise that triggers a panic sell-off, that more often than not, the sell-off was irrational and overdone, and that actually creates a chance to buy a quality product on sale, and that the market responds to that. And so that overreaction sell-off triggers new buy-on-dip opportunities, and it fights its way back up to what was the previous fair value, which is the real fair value. That's the idea behind overreaction, that sharp adverse moves are usually wrong. Channeling takes a more relaxed position, which says, well, this strong bullish target has drifted into oversold conditions, so I can just patiently and systematically buy it when it's oversold and sell it when it's overbought. So that's also a buy on dip opportunity. The triple screen, hat tip to Dr. Alexander Elder, is a more technical way of looking at strong on a weekly basis, weak on a daily basis to where it's pulled back below its 20-day moving average and then buy the second day of momentum as evidence that the reversion to the mean is underway. So that's sort of a more technical approach to buying on dips. The washout pattern looks completely at the other end of the curve and says symbols that have been oversold on an annual basis and on a 10-day basis are in a washout condition, and that everybody that was going to sell them has probably sold, and all that's left are the long-term stubborn buy and holders. And so that washout washed out all the weak hands, and so there's no more selling pressure left. And when we start to see evidence of buying pressure, this may be a chance to buy a long-term neglected symbol that is well below its 200-day moving average, and maybe we can start a buying program as it goes back to something like a long-term fair value. 5-day down pattern simply says that if symbols have been sold to a lower close 5 days in a row, that's probably statistically done, that the selling is over, and that if we observe the resumption of buying pressure, that might actually trigger a good opportunity to make up that lost distance. The Max Payne system suggests that in a population of 30 or 50 symbols, that those symbols that have lost the greatest percentage from their 10-day high are the most likely ones to have been an overreaction, and that there may have been some psychological momentum in the sell-off, and that maximum pain looks like an opportunity to get a rebound or a recovery move. Well, each one of those has their own hypothesis that suggests why it wouldn't be unreasonable to see a short-term move in the next 2 to 10 days. And so we've built swing trade systems around those. But sometimes the momentum of the swing trade could carry forward, and it might actually keep going, like when you think the run is done, but it's not. So there is some percentage of those things that could move from system B through the gap over into system A, and might actually join the monthly rebalancing longer term system A. So I think of that as growing the trade. So we've been doing this for about 20 years. And this was really the first step into hybrid trading, or that core and turbo trading, because we actually see this goes both ways. That you could have system A candidates that are working very well on the basis of monthly momentum. We use strong monthly momentum out of a large population of symbols to pick the ones that we want to hold for 1 month at a time. We call that the blended monthly rebalancing system. And so those tend to have some persistent momentum, and they hold for more than 1 month. Sometimes we've seen us hold that position for 2 years, where that symbol just kept outperforming for a 2-year period. You could look back over the last couple of years and see that as large tech cap, or large cap tech, like, the Amazons and Apples and Googles of the world. The triple Qs have just kind of been like that. Or the FANG, F-A-N-G index has been like that. Those things have been dominating for 2 years. So it may be that you find some of these long-term positions from the blended monthly rebalancing, and it turns out that symbol, while it's still going up, it might fall into one of those swing categories, and there's an even extra reason to want to own it. So you could do a form of core and turbo using blended monthly rebalancing and these different swing patterns. And it's not just these particular 6 systems. You might actually be able to do things like the owl, or the supported spring crossing, or adding second and third positions on pattern 4 of the regression line crossover. So adding combinations from the different time periods allows you to get synergy by finding multiple ways to trade the same standard targets. And now your span of control is reduced because you're just using the same symbol, but you're looking at 2 or 3 different ways in which you might get a benefit. That's like a farmer growing sheep who can harvest the wool periodically, sell off young ones, or grow the herd, and or get milk from them if it's goats and cows. And then when the animal's time is done, use all the animal, for eating and leather and whatever it may be. So we're finding multiple ways to create value out of the same set of targets that we study. So the idea of taking a sample of the world's opportunities and having a selected herd that gives you enough opportunities to do what you do, but enough focus to reduce your span of control, and then just enough patterns and techniques to be able to trade them in multiple ways in many different market conditions, looks like a way you can use focus to find out what really could work for you. So that's the relationship between core and swing type trading. And just in the same way that Ted Williams, this is his strike zone in baseball. The width is the width of the plate. The height is from his knees to his armpits. And he knew that based on where the pitch was thrown and where he made contact, that he had a certain sweet spot right there, right down. If you threw Ted Williams a ball right down the middle, he was a 400 hitter. And so this is, and he was a lefty. So low and inside was where he was least effective, 230 and 240. But he could hit the outside pitch high and away pretty reliably, 340, 300. But if you grooved it right down the middle, it was just a bad day for you as a pitcher. So one of the ways that we want to approach hybrid trading is to find those techniques and systems and time frames and targets that collectively give us really good averages. This would lead you more towards a system B, a swing trader, where you could study your performance and then optimize the patterns that seem to work for it. That's one of the reasons to be interested in swing trading. One of the reasons to be interested in the longer term core is that you might actually grow a trade that started as a day trade and you kept 1/5 of it as a swing trade, and that swing trade just kept working, and you say, you know what, instead of fiddling around and managing it every day, I've paid for the entire position with market's money already, so I'm just going to put a 10% trailing stop on it and leave it alone forever, or a 20% or 25%. Or just say, no, the entire position that I bought was paid for with market's money, so I'm just going to buy and hold forever and bet that they're not going to go out of business. So you actually have some discretion about what you want to use as a trailing stop, if at all, on those core positions, depending on how you got into the trade. So these were Ashok's questions of me directly from the Basecamp question board. So the short story on these answers then, could I please share some insights on core trading? Yeah, it's going to be this video, and I got a flashcard to show you. Are there any previous video links where I've talked about core and BMR? Yes, in the swing course on Basecamp, and there's an entire 15 or 20 hour course at VTI that's very well done. And I'm going to do an update of that one, I think. Is there any kata of BMR? Yeah, the systems definition paper on blended monthly rebalancing is definitive. It gives you the exact procedure to follow, and you can follow that procedure. It is a kata. Longer term, how do I switch from swing trades to core positions? I would say something like this. plan on keeping 1/5 of the swing. You have a swing trade position that scored really well. Keep 1/5 of the position. Convert to 10% at some point if it keeps working really well. That the swing trade position, it's not unusual if it was 2%. So if you were to expand that to a 10% trailing stop, you'd have to reduce the position to 1/5 in order to keep the same risk. Or instead of 10%, maybe it's 5 ATR. So that would be like core and turbo. That should be turbo. And then he asked, how do we select stocks for core trading? Follow the system definition rules in blended monthly, or just grow them from swing trades. This is the flashcard. Apparently there is some audio trouble. I'm gonna try. Hold on. I'm gonna try to transfer the. I'm gonna switch internet connections here. See if that will help. All right, let's try it now. Well, mic check. Mic check. Microphone check. Microphone check. What the? Mic check. Microphone check. Trying now. Mic check. Mic check. Test 1, 2. Mic check. Mic check. Testing. Let's try it again. Mic check. Okay. Well, that's I've got 3 different internet connections, and audio problem is I don't know. The produced audio will be okay, so I'm just going to press on through and then re-edit. All right, these are the different forms of core trading that are contained in the THARP course that I did. I just gave you the spiel of how hybrid trading can pull together core, swing, and day. That course walks you through different choices for passive annual rebalancing, quarterly rebalancing of a standard portfolio, monthly rebalancing. It talks about how you might break the portfolio into pieces. And then, for example, take 1/4 of that core portfolio and rebalance it each week, so that over the course of a month you've rebalanced the entire, but instead of getting locked into once a month, it gives you once a week. Situational conditional rebalancing is the idea that sometimes things like coronavirus happens, and you might just use a specific rule to perform a rebalancing based on environmental conditions. It covers the Harry Brown permanent portfolio, which uses very simple rules. It has you in a 4 buckets of money, and you only rebalance either once a year, or if the performance numbers of one of those 4 candidates, which is stock, the S&P 500, gold, long-term treasuries, or cash. And so it just keeps that money in those 4 buckets, unless one of the buckets outperforms, and then you rebalance if it hits one of those triggers. So it has an amazing track record, Harry Brown. The blended monthly rebalancing is a more technical approach. It has once a month rebalancing, and then you pick a portfolio that you want to manage, whether it's ETF 13, 22, 32, or some modified portfolio of that. And then you perform monthly performance review of all the members of that subset of the portfolio. And then you pick the top 3 and own those for a month if they're above their 4-month moving average. That's what's covered in the blended monthly rebalancing portfolio. And then you get different performances based on which portfolio set you're interested in. ETF2 takes that same general principle, but applied some swing trading concepts. It's a rule set that we built for a hedge fund about 15 years ago, still being used. And it blends sort of that core and swing trading approach with some risk management. From that, I would say the current set of core and turbo swing trading gets the best of all of those. It looks for opportunities each week to find either the very strong or the very weak as revealed by those strategies, and then looks at them carefully and looks to frame a trade based on the different patterns that we know. So I might look at something that is was very horrible, like healthcare, and discover, hey, on a weekly basis, there is an owl pattern forming. And then I can turn that into a daily chart swing trade. And so that gives us an opportunistic approach to finding low risk ideas. It's more active than once a month blended rebalancing, but you might be able to get better results by being opportunistic, by putting in the work. And so that's really, the essence of core and swing trading in that relationship, is to decide how much time you want to put into it. And that gets us back right away to that same original idea of system A versus system B. How hard do you want to work? How much effort and time do you want to put into it? And then you should have different expectations of performance based on the level of effort and skill that you have in each of those 2 different categories. And then we're going to realize that A and B, there actually is a pathway in between them. That sometimes we can take routine swing trades that just continue to perform beyond the 2 to 10 day range, and those things might grow to become just part of the monthly rebalancing portfolio, where we've just taken 1/5 of the swing trade, kept it, and then just put a 10% trailing stop on it and leave it alone. But it may also be something that is really performing well, like wheat and precious metals was for a while there. And it was being owned by the blended monthly rebalancing. And we found ways to add swing trade and day trade positions to it to take advantage of the positive parabolic momentum. So there is the ability to exchange information and targets and then manage according to System A rules and System B rules for the astute hybrid trader. Okay, that's what I want to say about that. That's plenty. We're an hour into this, so let me just get to the weekend reports. All right, so this is the weekend strategy report for August 22nd. Thanks for your patience. Bullish normal conditions, overbought longer term. There had been a slight pullback but recovery this week and this Friday. ADX is still a strong 24.8. The risk Z is still favoring longer term swings. It hasn't failed, and it's not at such an extreme reading that we think it's parabolic. So there's some long side opportunities. The current holdings for the core positions are mostly U.S. tech and large caps. And then when we look at the scores, those are still pretty strong candidates of outperformance. When we look at the other portfolios, these are the ones that are typically got the longest and strongest momentum. Apple, Home Depot, Procter and Gamble, Microsoft, and Nike. ETF2, the theoretical model exposure is 100%, so the entire global posture is favorable for holding long on the long side. The August has been just an amazing. It's pushing that all-time high at 340. We're past Z2, so to me, you got to have a stop in here to preserve the big gains that we've made so far. That's why for me that stop around 330 feels proper. That's about 3%. The weekly has just been, it has left this consolidation area and just surprising continue into March. You can see the 330 would be right about, it's going to be right about here. Oops. Basically at the Z1. And you know, I could see you having a stop at the weekly low, at the 2 week low, or at Z1. Any one of those would be reasonable. I would not let it. Certainly, I would not let it go below the skin of the dragon. A reversion to the mean would not be unusual as we approach the election. So 300 is actually in play. So to me, one of those four stops is justifiable just on a weekly chart. And you have to love, the strength of this weekly PSAR to just show you the indication of what's going on. Notice the power of the dragon to act as support the whole way up. The PSAR gives you that a longer term view, but to me it lags a little bit. I like it in terms of measuring how long we've been in that trend. But to me, on a weekly chart, the southern skin of the dragon is a very reasonable stop. Even the spine of the dragon works pretty well. And even if this sell off here got you out, then a resumption should get you back in, and then the southern skin of the dragon works pretty well. So as a rule of thumb, what you're just seeing right there is a technique where a hybrid trader that's using this strategy could add value to every single swing trade and core position that you have by simply using a weekly chart and these simple indicators. You can manage your stops for long-term buy and hold very easily, very effectively. Look what happened way back here when the dragon was violated and the PSAR flipped. That's when you adopt a short side position and you get supported fall crossings in here and you stumble into this amazing move. When it finally recovers and the PSAR flips, even on a weekly basis, when it was at 280, you had indications to buy, and then the southern skin of the dragon has kept you in that entire move, and it cost you a couple minutes a week to figure that out. You should be able, as a trader, to apply that rule on your own. You can just look at the chart and figure it out. I mean, really. The daily market health check, we had a nice recovery to the top of very near the all-time high, and they made a new 10-day high and 30-day high. Small range. The Z1 support level held all week. The southern skin of the dragon helped all week. That's at 337. So now here's 330. Yeah, right here. Here's 330 is basically the Bollinger Band mean. And that's a 3% move. So this big, tall red, that's a 5% trailing stop. Would you really give back that much of this move? Would you be willing to let it come all the way back to here? Maybe you would. For me, that PSAR is not bad at 334. That's a 2%. I'm happy with the stop there because I think everything north of Z1 is unusual. So I'm locking this one in here at Z1, 335. Or the PSAR 335. ETF 13 portfolio. So this uses the blended monthly rebalancing structure to rank on the basis of long-term momentum. it takes 70% of the 3-month, 30% of the 6-month, blends those together into an aggregate composite score, and then ranks according to the blended percentage. In blended month rebalancing, somewhere around the first of the month, we want to own the top 3 in equal dollar amounts as long as they are above the 4-month moving average. So right now, if we just did it today, those are the 3 candidates: the Qs, emerging markets, and SPY. For ETF 13 portfolio, ETF 22 adds, it takes the 13 of ETF 13 plus the 9 sector spiders like XLE, XLF, etc., and puts them into the mix. So you get to see XLK and XLY now at the top of the stack. And now you can see very clearly that winners win, that momentum tends to persist. These have been outperforming over every measured time frame, whereas the things that are bad have been suffering in every time frame. So momentum has a tendency to persist. Now, what makes this table, which is simply used to find which of that portfolio or the top 3, actually gives us other information, like, hey, this could be a resurgence now in treasuries, which had been third best on a 6-month basis, but have had a 3-month and a 1-month underperformance, but now are starting to look pretty good on a weekly basis. That could be a recovery in treasuries. I can go frame that as a trade just by looking at the information value of the table that I use to come up with the blended monthly. So I'm getting some leverage from an information point of view. Same thing now with ETF 32. We add a few more things like wheat and precious metals and clean energy and China and some other symbols that round out the portfolio. These are the performers, 1, 2, and 3, still doing well on a blended basis. But it looks like technology is starting to outperform clean energy and even wheat and precious metals, which is cooling off a little bit. But the things that are horrible, energy, oil exploration, remain horrible. That's so bad that it might be worth looking at as almost a washout pattern or an overreaction. So I'll go look at those simply because they've been beaten down so much. And then I can use this one to look at things like EWZ, my old reliable, which has been horrible on 6 months, brilliant on 3 months, horrible on 1 month. Look, that's why Brazil is such an amazing swing trade candidate, because it's manic depressive. It goes through enormous moves. It goes through these enormous moves on weekly and monthly basis that makes it very effective for targeted swing trading. You should be able to look at the chart and figure it out. I then apply the same logic to the Dow, and here Apple and Home Depot and Nike just crushing it. If you just stayed in these top 5 and managed them until the rest of these guys caught up, you could make a living just on the top 5 and using those as your selected target to exploit the relative strength. That's a strategy. Sector spiders, same thing. Pain persists, outperformance persists. Green versus red. And here's Treasury starting to make their little reversal move. Could this be the start of a sell-off in semiconductors? Maybe. It's starting to underperform, and now the recent one is starting to get even more below average. That could be done. So Intel and NVIDIA, maybe that's done. Then the long term, looking at the top 50 from among 350 sectors. This really helps you find the great big outperformers. ETF regional report. This is a different lens that we use. The lens we just got done looking at was the blended monthly rebalancing. This uses the lens of the ETF2 report, which now looks at strength, consistency, and quality, scales them according to a proprietary formulas on a scale of 0 to 100, and then blends those into an average, and then color codes those green, white, yellow, and red in the usual way to find exceptional outperformance or underperformance, and then use this as a guide for asset allocation. Like these 10 members of the world market model control about 10% of the theoretical model. When all of them are on a buy filter above their 4-month moving average, then we're 100% invested. But if one of these started getting weak and it went below its 4-month moving average, then we would take 10% off the asset allocation model, and then it would tell us what our relative exposure to the world ought to be as a function of how well these 10 big fat indexes are performing with respect to their 4-month moving average. That's the asset allocation model of ETF2, which protected the hedge fund owners and participants. It limited them to single-digit losses in 2003, the 2008 and 9 crisis, and then most recently. Single-digit % losses on a long-term core portfolio. That ain't bad. So this model not only can be used to guide how that system works, but it can give us insights about conditions in the world. And those are expressed here first by looking at the US. Hey, US large cap techs is in the green. Yeah, that's the Qs and XLK. Clear, it's standing up. Korea, Taiwan, silver, and Sweden. Consumer discretionary and technology. That's where the big money's being made. The UK is getting smashed. Some of these other things in the yellow are underperforming, and the white is above average, but not exceptionally. Standard work. Standard work. That, Ashok, that's how you find candidates on these big fat indexes. By reading the report. Looking for things in the green. Consumer discretionary, technology for the week ahead. Even gold is starting to make a nice little run. Here's another way to do it with the looking at the strength and consistency column. This puts into words what those traffic lights are telling you. This gives you a swing trade strategy in words about what you can do. Can you turbo trade those? The ones that are capitals and bold, especially you can do those. For the extreme leaders or the extreme laggards, those are the ones that give the greatest possible swing trades. So now I can come down here to South Korea. It's in the green on strength and white on consistency. Green on strength, white on consistency. It was good and is now great. Consistency is the last 10 weeks, and it's above average. It's coded white. But now its current strength is green, so it's now exceptionally strong. So I want to exploit new strength, and that's because it's a new leader. And there may be more buying pressures. People chase momentum. So I can certainly turbo trade this one intraday. Because these are all very liquid. So that's how I find South Korea as a target. Oh, the MSCI India Index Fund, INDA, is also green and white. Hey, guess what's losing strength? Germany, it's white and green. Hey, guess what's been great? Home construction, silver, tech. You could base an entire strategy off of just this page with weekly adjustments. This one shows you the symbols that are the most liquid based on average daily dollar volume of the last 30 days and how volatile they are. So what makes a great short-term trade? Something that's very liquid and very volatile. Oh, so you mean like gold, silver, gold miners, the energy sector, Brazil, gold, biotech, and oil and exploration. Yeah, that's how you find candidates to trade for core and turbo, for swing, core, and day trade turbo. That's how you find them. Then go look at the patterns and frame of trade on hourly charts or 2 hourly charts or daily charts or 30-minute charts. This one shows you the entire ETF2 database for the top 100 based on average volume. So the exceptional performers, we just took a look at the extract of this on the previous page. But then this one gives you the whole stack sorted by strength. Green, these are more than one standard deviation above average, exceptionally strong. White means it's above average of this database, but not exceptionally so. Yellow, it's below average, but not horribly painful, down to what is exceptionally underperforming. It's from the exceptional ones, exceptionally red or exceptionally green, that the biggest performance comes from. All right, shifting to the daily. So that's how you can use the weekend report to find and manage targets. And then look at the charts the same way I just did on monthly, weekly, and daily, using our indicators to come up with certain ideas about where's the patterns that I want and where are the stops in. The swing trading course and the hybrid trading course show you how I did that every day for 5 months through the pandemic. Mike, a person doesn't have to create the statistics. They can look at the report, but you can find the targets the way I'm describing them, and you can apply the hybrid trading principles to study the patterns and frame the trade, or you can apply the swing trade mechanical systems and their patterns to it, or you can follow the rules that are written in BMR, or you can study that material and develop your own personal adaptation. That's the educational part of this thing. So yeah, you got to read the reports and study the lessons and do the work. I'm not trying to yell at you. I'm trying to encourage you with some urgency. All right, to the daily report. These are the min paying candidates are the ones that have fallen the least from the 10-day high. The max pains are the ones that have fallen the most from the 10-day high. So that gives you a way to find, using relative strength, winners and losers, so that you could frame trades that are like 1 to 2 days long, sort of like swing trading 1 day at a time. So that is a strategy, swing trading 1 day at a time. So this is a place where you can find those candidates quickly on the daily report. That's a proven strategy. The Risk Z gives you insights into how well suited the market condition is for holding swing trades. It says risk on. This whole section of the report, this collection of indicators, are all ways that you can describe market conditions to determine if swing trading is suitable or not. Right now it is very suitable on the bullish side. This section here, channeling an overreaction, shows you there's only 3 rules for overreaction on when to get in. And there are no signals. So like if the S&P had closed above its 200-day moving average, it did. That's why it's on a yes. If the for Rule 2 to fire, the daily high would have to be below the 10-day moving average. So it would have to have a sharp sell-off below the 10-day moving average. That's basically the other side of the dragon. And it'd have to be more than 1 ATR. That's the long trigger, is more than 1 ATR from the 10-day high. So as a point of reference, here's what would have to happen tomorrow in the S&P for that to fire. We would have to see we'd have to see this. The price is up here right now. The spine of the dragon is the 10-day simple moving average. So it would have to have a sharp sell-off. Like say there was some news, like it was a big gap down, and then it kept selling off and never recovered on Monday. You would have to see a price that looked something like this on Monday. You'd have to see price action like that for the overreaction to be triggered. All right. So it's still above the 200-day moving average. But there had to have been some kind of news event that triggered a panic sell-off, and then all of this price action is below the dragon spine, and it's more than 1 ATR from here to the 10-day high. That would trigger the overreaction. The channeling system would be something where the 10-day high is here, and that thing sold off to an oversold condition, and then you could buy tomorrow's open, because the belief would be, oh, this thing just drifted into oversold, and so we want to just buy it when it's oversold, and then it moves back to fair value and resumes this long, strong trend. This was a channeling signal. This one was almost an overreaction, except you see some of the price was above the spine. It would take this kind of trigger to get you into the overreaction. So that's a pattern trade, and those are both so reliable as swing trades. They're like 0.7 reliability in a bull market, that I track the great big fat indexes against those rules. Like the channeling only has 2 rules. Is it above the 200-day moving average? Yes, in most cases. And did the Williams percent R10 fall below -80? That's like a 10-day NDX below 20. Not everybody has that on their chart packages, though. So if it was a bull market but then was oversold, you just buy it tomorrow. That's the simplest rule there is, the simplest system. And that thing is about 0.7 reliability for the last 20 years. So not only do we use that on these big fat indexes, that also becomes really good information about the condition of the market. Like you can see already that 9 out of the 10 are above their 200-day moving average. That's a good thing. So sometimes these swing trade systems are systems themselves, but also they could be indicators to be used for other patterns. That's why I look at when I'm looking at the Dow 30, the 30 symbols of the Dow, I look at channeling, overreaction, washout, 5DD, triple screen, 551W, max pain range compression, and are they in a doji? Because this summarizes opportunities based on those previous patterns that I just described. The auto framer is a strategy that looks at the reward to risk ratio of a return to the 10-day high. So something like Cisco is in a doji and offers 10 to 1 on a return to the 10-day high. That's amazing. It has a strong frog quality number of 3.2, which means it's been pretty stable in terms of the frog box. And it's been underperforming 10 days, 30 days, and 3 months. But it didn't underperform on Friday. So maybe this thing is recovering. In fact, the doji says that maybe the suffering is over. And that means a reversion to the 10-day high could give you a 10 to 1 trade. So I can use that simply to find a trade frame in Cisco. And those of you that have been playing along here on the dailies know that we've been tracking that one pretty close. Closely, I should say. Yeah, while this is loading up, and for Mike, you had asked me earlier about how to get started. The way to get started is to go through the trading lessons in Basecamp and the hybrid trading, and you'll pick this stuff up. So for you swing traders out here, here's what a 10 to 1 reward to risk ratio looks like in Cisco. So as I look at Cisco, and we go all the way back to February and March, it suffered like everything else. And then as it started coming out of here, we were trading this on day trades and swing trades as it moved up the stack, leg 1 and leg 2. And then it's been just in this sideways quiet channel up here for a long period of time. It was in that sideways grinding channel for a long time. And then there was an earnings announcement in which it sold off sharply down to here. And then for the last 7 days, it has tactically sold off, but it never broke down below this previous belly of the RL10, which and the PSAR flip. When we extend that across, we say, oh, there was a support level right there. And in fact, the last time when it sold off, moved higher, and then sold off, this was the support level that triggered all of the buying that moved it up to 50. Sold off, recovered back to 50. Sold off harshly, but never violated below the support level at about 41. And in fact, when we zoom in on it, it's had 5 days in a row where it hasn't violated this little support level. On this basis, I actually bought some yesterday. Because we had set up this little trading box. We said if it broke out of that box, I'd be willing to buy it. So I did. With a stop right here, just below the 2-day low, or this 10-day low, essentially. So if we looked at that, the entry was at 42.21. The stop is here, 41.71. So that's about 50 cents. So if I'm risking $400, that means I buy 800 shares of Cisco, and my targets to the upside are fair value at 43, Z1 at 44, upper skin of the return, let's call this return to the previous Z3, 44.87, upper skin of the dragon at 45, PSAR flip and the Bollinger Band mean at 45.80. All the way up to a 10-day high, something like 48. So I'm only risking 50 cents. 1, 2, 3, 6, 7, 8, 9, 10. Yeah. And there's a potential $8 or a $6 move from 42 to 48 with all of these possible support levels. So if this thing starts moving up and then starts to stall here, I'll cash and make bank. But if it gets through here and starts moving up, I'll buy a second position. If it gets to here and starts to roll over, I'll cash, make bank. So each one of these is where I invoke the 2R battle drill. The fact that it had 7 days and didn't fail any further tells me that all of the pain and suffering that was triggered by the earnings announcement has been baked into the cake. Everybody who was going to sell that has sold it. So there's buying pressure, including me. Luis asks, would I get back if it made a new low, like it broke below 41.71? Well, then I don't automatically get back in if it comes back in. It has to meet one of my patterns. But this looks like, let me show you what this looks like on the 30-minute chart. This big green blob, this purchase at 42.21. Guess what this looks like, friends? Now, here's your quick quiz. What pattern is buying it at the green dot? Supported spring crossing. There's your harsh winter. It held support at the same place that it held support 1, 2, 3 times ago over the last 7 days. Over the last 7 days, it has held support at this level, and now it went from winter to spring. So I buy it in here and I get filled at 42.20. Now, this is the upper. I'll get my ellipse. Where are we at there? Here's a target. These are all the targets that I just identified from the daily chart. I would not be surprised if it got back to that level over the next 2 to 3 weeks. Well, why is that? Because the last time it was down at this level, it, in a matter of a week or 2 weeks, it got up to 48. When this was way over here, look how fast it went from 42 to 48. It went that far that fast in that period of time. So how fast could it get back to 48? That fast. So this thing could actually go something like this. That's what that line looks like. So all I'm doing in a symmetrical trade, this trade that I just started down here is the same trade that I took in here. And you're going to notice I got 1, 2, 3 positions in quick and then started replaying it. So here's the trade frame that we're going to go study. My hypothesis is that I don't have any reason to believe that Cisco won't do this again. It's already done that. So let me walk you through the Cisco trades. We bought the Z3 breakout from here and got 1, 2 positions in, cashed, repurchased it here. So here's one where it sold off to the previous lows. I could have bought it here. I didn't because it was a gap up. I just waited until it stabilized, low, higher low, higher low, and then bought the shift from winter into summer, scratched, rebought it, and played this move. So you asked me, how do I re-enter? On the basis of favored patterns. This is absolutely fractal. This just happens to be the 30-minute chart. The opportunity was set up by the daily chart. So when I go back and look at how Cisco behaves, a move from this level of about 42 out of this yellow box gave a pretty strong move. It gave a move from 42 to 48. That's $6 on 40. That's a 15% move in 10 days. That was people buying it on a dip. What do you mean buying on a dip? I mean, it was buying on a dip. This thing had moved to here, sold off, moved back up, sold off. So when I start buying it in here, I'm hoping just to get to here. And that's why we took this exit at this level. The actual exit hits, that was where we put the stop, and it triggered us over here because it got this far, and then that's a sniper exit. Because we knew that if it got to this level and started to fail, it could be bad. So I'm using technical analysis and our indicators, the RLCO frameworks and the belly of the dragon and the RL10s to frame decision points. That's what I mean by trade framing. So on the larger scale, when I see this swing trade frame, it moved from that low to that high 15% in 10 days. So now when I fast forward and I see that same trade frame at the same price levels happening over here, I say, that's not unreasonable to say. You can't tell me that's not reasonable. The most recent evidence was that it did that. Hey, here's another case where it did that. It also moved approximately, in this case, it went from 44 all the way up to 48, and at 48 it collapsed. So look how long it took that time. It took to do it that time. Same trading range, the same box, but what we're doing is that we're noticing that when things get oversold, and you can buy it on that supported spring crossing, you can actually maybe get pulled along into a nice swing trade, and then it gets smashed all the way down here. But it didn't fail any further. There was buying pressure that came in and stabilized it, and now it's starting to move up. And I said, you know what? On the basis of that, I can have a very little risk of 50 cents. That's what this 4171 is. That's a Z3 excursion. It would have to do a Z3 breakout to this way. But if it doesn't do that, it might go up on that line, or it might go up on this line. I don't know which one of those lines is going to hold. I hope it's the first one, because I want to get paid sooner rather than later. So which one of these boxes is going to be the one that it follows? I don't know. No idea. That last time, it only got that high, but maybe it could go this high. I don't know. If it stayed on that line, it might just look like this. Now, this is a low-risk idea. It failed to fail further. It's holding the Z3 line. And it showed some evidence. There's the RL10. There's my entry at 42.21. It held support, held support, held support, held support. Winter became spring. It crossed the dragon. That's the supported spring crossing. If it breaks out of this box and gets to that level, if it gets to 42.60, I'll add a second position here, whether it's on this line right away or this line, or if it's some other slower line. As long as it's not failing, I don't care. Maybe it looks like this. As long as it stays on one of those lines, I'm good. Because my stop is down here. At some point, I'll be able to go from this stop to no lose plus dinner for two. Once I get that one locked in, then I would have gone from risking this much to locking in this gain. And then the further that it goes up, I'm good to go. This is where I would add a second position and a third position. And then if this thing exceeds all my expectations, but it achieves my dreams, it gets up here to 48. And I would have made $7. Now, I hope it goes that fast. As long as it's kind of above this, this would be an A trade. Anything better than this is an A and a B and a C. If it's down in here, maybe I just trim it. Like if it gets all the way out here to the 14th, like 10 days, and it still hasn't gotten up into here, then that's horrible. Then just recycle my money. So this is how we can think about grading the trade. How well is it performing compared to these historical norms? That is what swing trading one day at a time is with hybrid trading using Cisco. This is how you find low risk ideas. Cisco was the anomaly. What do I mean by the anomaly? I mean Cisco is 10 to 1 reward to risk ratio. Boeing is 6.8 to 1. Well, what does that look like? And Boeing was a big, huge loser on Friday. What does Boeing look like? I don't even have it on the chart here. Can't think it. Because you can only watch so many symbols. But now maybe Boeing is of interest to me, so I put Boeing on the chart. Let me start with the weekly. I'm going to go through the multi-time frame, multi-lens analysis on Boeing now. On a weekly basis, this is horrible. There's nothing to love about this. It has this tight trading range, or is there? Tight trading range here between the peak of the RL10 and the belly of the RL10 and the PSAR. So there's this tight little, maybe even the peak of the dragon. Maybe I could treat this as the yellow zone. I would be interested on this. If I could buy Boeing above the hump of this dragon and the Bollinger Band mean, I would buy it at 185. And I would certainly go short if it broke the PSAR. I might even be willing to go short if it broke below the weekly low. This would be an even more aggressive trade frame if I did this and use the width of the dragon. Now what I've done is use the width of the dragon. So I could go long if it broke out of the yellow boxes to the north. So I could get a first position at 177 instead of 185. Why would I do that? Because I get $8 of price improvement. Why am I interested in that? Because look how far this thing can go in 1 week. I don't know that it won't do that. Look how far it went in 1 week. Look how far it went in 1 week. Boeing is explosive. So it could move that far up in 1 week. Or it could move that far down in 1 week. So there's my trade frame on just using weekly charts. What's that look like on a daily? Well, where would I add a second position? So there's my first position, second position. Third position I would put in if it broke above the RL10. Third position here if it broke below that 2-week low. That's about where I'd put a third position in. So if this thing makes a huge weekly move, I'll get 3 positions in. So now let me look at the daily. That is even a little bit easier to see, I hope. Now suddenly, let's see, I'll get this. So now when I expand from the weekly expand from the weekly to the daily, and I put this thing in perspective, you can see how I can quickly get those positions in. Now, actually, I'm actually interested in if this thing can get out of the daily dragon or above Friday's high, because it's in the bottom of its river channel. I might be able tactically to make these trades and just trade in the yellow zone with a smaller risk using a hybrid frog entry. Like I'm ready to buy this thing right here. Like if it made a new high, I'm ready to buy it, thinking it can get to the tops of these yellow boxes. So now my intraday minimum manageable risk box looks like this inside box here. I'm going to make it blue just so that we can distinguish. So now my box, my day trading box, looks like that. We'll go down to the 30-minute. Now look how interesting this is. So let's suppose that this thing opened, it opened right there with no gap on Monday. What I just framed was I'm willing to buy this automatically at 171. But now watch this. Look how narrow this box is. When this thing is non-directional, it's only that big. That's only $1. So what I'm going to do is I think the minimum manageable risk box on this is $1. Let me try to, I'm going to make that one blue also for tactical trading. So what I'm going to do for Monday for Boeing is this. If it breaks out of that yellow, out of that tiny blue box, I will go long north or short to the south. And why is that a good idea? To me, it feels like a good idea because here's how fast it can move in 2 hours. Look how far it moved in 2 hours. Just to get from The same price level that it is right now, it moved all the way up here to 171 in 2 hours. So it could very easily move just like that in 2 hours. So if it does that, I want to own that. So if it makes this move, it could move that far, that fast, just using historical precedent. And then when it gets to that new level of price that everybody's satisfied with, all it does is nothing. All it does is it then goes sideways, for a long period of time. So the longer, let's say it got this far, I think it's going to give us the red line move. Or let me make that green because it's good. So if this thing started moving up and out, but instead of going where I wanted it to, which was all the way up here, but somewhere in here, it gets above the Bollinger Band mean and then starts to fail, I could just make a decision to cash a fraction. Or if it got this high to Z1 and then started to fail, that's like the 2-hour bet, cash. And then it got up in here and started to fail, cash. But it got out of this blue box, add a second position, add a third position, add a fourth position. And now by the time I get out of this big yellow box, hey, remember this big yellow box that we're looking at? That was the small yellow box. So I could get 4 intraday positions, and then that could become a swing trade. And then if it gets out of the big yellow box, we're off and running. And then this thing could get as high as this big yellow box or the big green box in 2 weeks, which was this move over here. So there is trade symmetry and fractal framing. This is why I say frame the trades with the multi-time frame, multi-lens analysis. Look for those periods of pinch and stretch. Boeing is in a period of pinch. It's pinched. And the big boxes are what it looks like when it stretches. Is it gonna? I don't know. But that's the normal dimensions of Boeing's moves. Hey, even if it only did what if it only got this move? Do you want that move? That's how fast it could happen. And that's over 3 days. So that's like from morning. Let's count the days. This is a 1-day time frame right here. 1 day. So it could make that kind of a move in 1 day. We've already seen it. So Boeing is in a critical state. So one of the reasons that I look at this chart right here, the auto framer reward. We just looked at Cisco and we just looked at Boeing. That was number 1 and priority 2 on the max pain range compression. Guess what else they were? A doji and a doji. Doji. Is this a critical state? It could be. Small range, a close was near the open, large move in either direction. That's a strategy right there. Auto framer plus a doji. So that trade, frame your trade and trade your frames. That's everything I want to cover on the weekend report. Okay. Or is it? Now, we're going to go all the way through it. Why? Because we're here. You don't stop when you're tired. You stop when you're done. All right. ETF tactical. Silver is 3.3 to 1. Energy is 5.5 to 1. Energy was a doji. Silver was a doji. Technology was a big winner. The triple Dow was a big winner. Metals and mining and oil exploration, the whole energy sector just got smashed. There's lots of things that have sold off on the RSI too. So all of those are exceptionally bad. So let's just look at XOP. Very liquid, 4.6 to 1. A 3 on the RSI2. Remember, RSI2 is a short-term extreme. When it's less than 10, the traffic signal lights up. It's underperformed on 1 day, 10 day, 1 month, 3 months, 6 months, 12 months. It has underperformed all of the other members of the ETF 30. It's just horrible. Oh, it may be so bad that it's good. Look where it is on its NDX. 5, 19, 18, 46. So on the 10 day, 1 month, and 3 months, it's dramatically oversold. So this would be the last one we'll do, XOP. So there was a question. How do you get the various chart tabs in TC2000? You just go up in here and you click and you get another tab. So this is the one that I'm using for this particular setup with the Bollinger Band means and the river but I have other views that I look at with different combinations of indicators and pictures that gives me a different visual display. This is a very minimalist one. That one adds the RL270. So there's all sorts of things that each one of those tabs you just get. That's a feature of TC2000. That's not a feature of Platinum. My Platinum package. Now, what you ought to look at is the KL bundle. You can buy a beautiful toolkit that's fully integrated with all of the symbols, all of the setups that Danny has put together with filters and an explanatory course for $4,000. And you can find the movers and implement all these. You don't even need my daily report because it automates the bundle. And Milt will tell you. He just said, hey, he has the bundle and it's awesome. It's unbelievable, and he keeps adding to it. I mean, holy mackerel. Make it as hard as you want, but what's an hour's worth of your time? Or what's an hour of your time worth? That bundle is like paying one-time payment of $4,000 for an executive assistant that never gets tired, never makes mistakes, finds all kinds of setups for it. So here's XOP. I'm going to look at the weekly. Not in bad shape, but kind of flatlining. All right. Daily has had a significant measured pullback. I like that. From a 10-week high to a 10-week low. And what if this is the place where it finds support at Z-1? Not unusual. I look at it this way. Here is where it, on the 10-week basis, this is where it's oversold. This is where it's overbought. It went from overbought to oversold. So if it, why do I think that it could hold support there? Because the last time it was here, it went to here. So it could do that again. So there's my trade frame, and then there's a couple built-in price levels. Break out above the weekly high, break out above the Bollinger Band main, finds resistance at the edge of the dragon, breaks out of the river at Z1, breaks out of the dragon PSAR flip, which is also the RL10 peak. I'll go look at 30 minutes. There's my trade frame where I want to add positions. And now I can actually, I can look at this as the minimum manageable risk box, can't I? When there's no directional interest, isn't that how volatile it is? Yeah, nothing. Nothing. Here's one where it broke out of that range box and went to the downside. And then it went from the downside and it hasn't done anything except go sideways. So this thing could very easily go from here to here. And it could go from, and if it broke out above the Bollinger Band mean, it could go to Z1, to Z2, to Z3 in fair value. That would be nice. So I'm ready to play a trade frame on this one as soon as it breaks out and does a PSAR flip. And how big is that? That would be a long position at 52. Would I be willing to get short? I sure would at 51.37. So that's about 60 cents, 50 cents, 50 cents. And it could get 1, 2, 3, 4. Just to get to Z1 is 4 execution R. So that's XOP. Using the multi-time frame, multi-lens analysis. Would I be willing to go short? Yeah. That one's even easier to see. Because if this bottom box fails, this thing's horrible. And it goes all the way back to here. That's what the downside looks like. It'll come all the way down to here. There was a time when this thing was amazing. It was up here at 72. So I'd like it to go that far, but it could start with all of these little fractal trade frames. So that's everything I want to cover. So Michael asked the question. Oh, first of all, hey, yeah, Luis asked, is there a bundle for TradeStation? Yes, there is. It doesn't have all of the things that the TC bundle does, but if you go to tortoisecapital.net, you'll see a tab that says TradeStation. There's 3 bundles, and there is an extensive set of examples and the system specifications. If you can't find it, send me a note. But go to tortoisecapital.net, and then you can see all that. And then Michael asks, in the Super Trader course, there is an Excel file which calculates the system quality number and which one to use. Is that file working on no, the spreadsheets for the core course, those were built like 10 years ago when Yahoo and Google were all providing free data. To use the spreadsheets I use now, you got to have a paid quote server. I sent them a list of how to do that if you wanted to do it. They have an update to the instructions, but I wouldn't use those spreadsheets anymore because the change in the quote server has made that more expensive. I will tell you, Danny's already got the blended month rebalancing, all that stuff built into the TC2000 bundle. And then you can actually buy that bundle with the ability to back test it in TradeStation. That's bundle 3. So I will let you guys go study that. But we've been at this for a little over 2 hours now. So I want to call it there and get it produced. Okay. So hopefully you found that last hour useful. Okay. Take good care, guys. And we will catch you in the chat room.